Welcome to the deep dive. We know your time is valuable, so we're going to jump straight into the source material.
We certainly are.
Today's mission is, well, it's pretty targeted and pretty critical. We're dissecting the big question. Could the instability we're seeing in today's market signal a second Big Short?
And we're going to break down all the complex financial stuff into clear, usable insight for you.
The person really putting the market on high alert is Michael Burry. Again.
Yes, the legendary investor from the film The Big Short.
Yeah.
And he's not just, issuing some mild warning. He's taken a really dramatic action.
Extremely dramatic.
It implies he believes a severe market reckoning is basically unavoidable now.
That's right. I mean, he didn't just tweak his portfolio. He publicly announced he is closing his hedge fund, Scion Asset Management.
And returning the capital to investors.
The vast majority of it. And his reason, stated explicitly, is that the stock market is just too overheated.
He says corporate valuations are, and this is the key, dangerously divorced from financial reality.
It's an extraordinary move. It really demands our attention.
It does. When a figure like that, known for seeing crises before they happen, just walks away, you have to pause.
So that's our central question for this deep dive. Is Burry just, tired of the volatility?
Or, given his almost perfect track record, is this the biggest signal yet of a new crisis on the horizon?
That's the crucial analysis. Let's start with why everyone listens when Burry talks. He's the ultimate contrarian.
He really is. When all the big money is flowing one way, he's famous for betting on the complete opposite path.
And his warnings about market shifts have been, well, eerily precise.
His successes are market legend at this point. He spotted the dot-com bubble collapse back in 2000. And then, critically, he saw the weakness in the housing market years before 2008.
Years before.
That crisis, the Lehman event, it almost brought down the entire global financial sector.
Yeah.
And Burry's firm made hundreds of millions of dollars betting against that flawed subprime market.
A bit so contrary gave us the phrase, the Big Short. So if he's sounding the alarm today, what specifically is he pointing to?
For a few years now, Burry's been really critical of the huge boom around AI and tech companies.
A frenzy that really took off after the pandemic.
Right. And his core complaint is, it's fundamental to every speculative bubble. He's arguing that companies are being valued based on a captivating story.
The story. Future potential, revolutionary tech.
Rather than actual measurable performance, revenue, earnings, actual cash flow.
So he sees what's happening now. The NASDAQ at record highs, all driven by AI, semiconductors, big tech, as a pure bubble.
He's drawing a direct line from today back to the mania of the dot-com era.
But here's the critical distinction we need to make.
Yeah.
Is this a correction risk, like the dot-com crash where a lot of bad companies just failed? Or is it a systemic contagion risk, like 2008, where one pillar falling brings down the whole house?
And that all depends on what today's equivalent of toxic debt really is.
Exactly. To even begin to understand if we're facing another Big Short, we have to understand how the first one worked.
Yes. The subprime crisis is notoriously complex, but we can definitely simplify the steps that led to that global meltdown.
Let's spend some time here. The history really informs the present. Let's start with the basic mechanics of 2008.
Okay, so the foundation was just a standard mortgage, a housing loan. The house is the collateral. That's safe, prime-grade lending.
The normal stuff.
The normal stuff. The system failed at step one, subprime lending. Banks, driven by greed for fees, they just threw their standards out the window.
So they started lending to anyone.
Pretty much. People with bad credit, no income verification, no job. The loans were made under the insane assumption that housing prices would never, ever fall.
And that recklessness created the toxic asset right at the source.
Precisely. Which leads to step two. MBS, or mortgage-backed securities. Banks didn't want to wait 30 years to get paid.
They wanted their money now.
So they packaged thousands of these loans, these promises of future payments, and sold them immediately as a security. This turned long-term debt into instant cash, which let them make even more toxic loans.
And this is where it gets really dangerous, moving from bad loans to a systemic failure. The CDOs. Collateralized debt obligations.
Yes. Step three. This is the financial alchemy. Other firms bought up those MBS packages, the ones filled with toxic subprime mortgages, bundled them together with other debt, and then sliced them up into new, really complex products. These were the CDOs.
And crucially, these were then sold to huge investors, pension funds, insurance companies, as if they were safe.
And that's where the corruption became catastrophic. The rating agencies.
They were paid by the banks to rate the risk of these CDOs.
That's the systemic flaw. That's what let the crisis go global. Even though they were filled with junk, the rating agencies, motivated by profit, just stamped AAA ratings on them.
Making them look as safe as U.S. government bonds.
It was a total deception, and it allowed this toxic debt to infect the balance sheets of institutions all over the world who thought they were holding safe assets.
So when the economy finally turned, house prices fell, and those subprime borrowers defaulted.
The whole house of cards came down. The debt failed, the AAA CDOs failed, and every interconnected bank that owned them started to go under.
Triggering the global collapse.
And that's where Burry made his move. He used something called a credit default swap, or CDS.
Which is basically insurance.
It's an insurance contract against default. He didn't just bet against the housing market. He bought hundreds of millions of dollars of these CDS contracts on specific bundles of that subprime debt. He was betting the payments would stop.
And when they did, his insurance paid out. Spectacularly. That was the Big Short.
That was it.
Okay, that context is absolutely necessary. So now the hard question. If 2008's danger was toxic debt hidden by fake AAA ratings, what's the contagion risk in today's AI market?
The parallel isn't hidden debt. It's concentrated, non-performing capital dependency.
Explain that.
In 2008, the contagion was bad debt spreading through derivatives. Today, the worry is that the contagion spreads through market concentration. The whole market's valuation depends on the wild success of just a handful of companies.
The Magnificent Seven effect. So if one of those mega-cap stocks fails, the market correction would be brutal just because of the concentration.
It would be. But is that a true systemic collapse or just a really deep sector correction?
That's the key distinction.
It becomes systemic when the failure of a company valued purely on its story starts pulling down other seemingly healthy companies that are deeply linked to it. And the sources give a crucial example. OpenAI.
Right. OpenAI is the symbol of the AI boom, but reports suggest its costs are just astronomical.
Precisely. Reports say OpenAI might be losing up to $12 billion a quarter. The capital needed for training models, building data centers, it's enormous.
But the valuation stays sky high because of the belief, the story of future profits.
And if that monetization fails to happen or gets severely delayed, what's the contagion risk?
The dependency.
Exactly. If OpenAI fails to become profitable at scale, that failure could drag down other successful companies invested in it, or companies whose entire business model depends on serving that ecosystem.
So the contagion spreads through the supplier demand chain, not just financial instruments.
Yes. It's a fascinating parallel. In 2008, the borrower failed, taking down the debt instrument, which took down the bank. Here, the failure of the hypervalued user of the tech
takes down the supplier of the tech.
And that hits valuations across the board, even if the supplier itself is profitable right now.
Which is exactly why we're seeing some very smart people making skeptical moves.
Burry hasn't just closed his fund. He's actively taken short positions, betting on price drops against key AI stocks like NVIDIA and Palantir.
And the sources confirm he's not alone. Billionaire investor Peter Thiel's fund, Thiel Macro, completely sold off its huge stake in NVIDIA last quarter.
That's $137.5 million. It's a very clear signal that some major players are questioning if these prices can last.
Now, we have to give the counterpoint here. Wall Street is not, in a unified panic about this.
No, not at all. Firms like Baird are quick to point out that the fundamental demand for the hardware, like NVIDIA's chips, is still incredibly strong.
There are no signs of it slowing down. Corporations, governments, they're all still spending billions on AI infrastructure.
So the demand is real. But Burry's critique is aimed deeper at the valuation. This brings us back to the core question.
What actual profit is being generated by the companies buying all these chips?
Right. If the companies using the chips, the OpenAIs of the world, are just burning through capital and are years away from real profit, then the value of the chip maker, no matter how dominant,
eventually becomes questionable.
Yes. Burry is saying the foundation of the profit model is shaky even if sales are strong right now. The system is consuming capital at an unsustainable rate, all for the sake of the story.
And this is really the crux of the analysis for you, our listener, trying to navigate this. We are left with two radically opposed perspectives on this moment.
On one side, you have the view that this AI boom is a genuine technological revolution, like the internet itself, something that will eventually justify these huge valuations.
On the other side,
the Burry perspective, that this is a classic speculative bubble fueled by irrational exuberance, where story has dangerously, completely trumped performance.
The consensus from major financial papers like the Wall Street Journal or the FT isn't don't invest in AI.
No, it's much more nuanced.
It's a specific warning on valuation. They're urging investors to look past the hype and really analyze the fundamental performance, the actual numbers.
And the lesson from every single speculative boom before this, especially the dot-com era, is our best guide.
What happened then?
When the crash came, the companies with solid fundamentals, the ones with real profit, sustainable models, think Amazon, think Google, they survive.
They survived the correction and became the leaders we know today.
While the huge majority of story companies just vanished. The challenge for you is figuring out which companies today have that real performance that can endure the correction that will eventually come.
That's a huge challenge, especially because, unlike the toxic debt of 2008 that was hidden away,
Right.
the high cash burn and the uncertain path to profit for these AI companies, it's all visible. It's out in the open.
It is. So we've unpacked Michael Burry's grave warning. We've revisited the mechanics of the original Big Short Subprime MBS CDOs. And we've highlighted the current risk linked to AI concentration and this valuation based on pure narrative.
So for your final provocative thought, let's contrast the two crisis models. 2008 was built on hidden bad debt, obscured by complex derivatives and false ratings.
Intentionally obscured.
Yes. Today's concern is about massive capital flowing into high-growth companies with widely known but accepted uncertain profits. The risk isn't hidden, it's being rationalized.
So you should ask yourself, which type of risk is actually harder to identify and prevent? The hidden, complex financial weapon, or the risk that everyone can see but chooses to ignore because the story is just too compelling?
And if you wanted to test the real health of this whole AI ecosystem, what single data point beyond NVIDIA's immediate sales numbers would you track to judge if it's truly viable?
That's the kind of thinking that moves you from being a passive consumer of news to an active analyst of the market.
Use this synthesized knowledge for your own analysis and future explorations. We'll see you next time on The Deep Dive.